What are the big ideas that will drive the CEO agenda in 2025? What do CEOs have on their front burner? Seasoned experts, Tola, Adeyemi, CEO, KPMG West Africa, and Abayomi, Olarinmoye, senior partner, Verraki, will dissect some of the main areas and 2025 trends for business. Hello and welcome to another episode of Global Business Insights, where we bring ideas from seasoned experts and analysis diving deeper into the headlines. First, some of the main stories. Oil prices are inching higher as geopolitical risk threatens supply once again. Markets are rattled after the sudden toppling of the Syrian government, sending shockwaves through the Middle East. Syrian president for 50 years, Bashar al-Assad, has fled the country for Moscow after rebels seized the capital city of Damascus. Brent crude still under $72 a barrel. The uncertainty weakened South Korea's currency to its lowest level in more than 2 years today amid the brewing political crisis. President Yoon Suk-yeol barely survived an impeachment vote over the weekend. And in an interview also over the weekend, Trump assured markets that he had no plans to remove Federal Reserve Chair Jerome Powell. His term ends in May 2026. Volkswagen and Labour representatives are in a fourth round of talks over wage cuts and possible plant closures in what has become an increasingly bitter standoff. This is as Volkswagen wants to radically cut costs to compete with cheaper Asian rivals. Japan's gross domestic product grew at 1.2% in the 3 months through September from the previous quarter, beating a preliminary estimate of 0.9%. The economy grew at a faster pace than initially reported, thanks to upward revisions in capital investment and exports. The signal of a resilient economy revives expectations for a near-term interest rate hike by the central bank. And in China, November inflation, that CPI year-on-year, was up 0.2%, less than expected and a 5-month low. The core CPI, excluding food and energy prices, continued to rise with a 0.3% year-on-year increase, up by 0.1 percentage points from the previous read. And in Ghana, the opposition leader John Mahama is set to win Saturday's presidential elections after voters penalized the ruling party for its economic. For African CEOs, the need for a strong ethical compass is a big lesson for 2025 as McKinsey & Co. settles a major case involving hundreds of millions of dollars bribery in South Africa. While CEOs continue to find the public sector a difficult terrain, the private sector needs to help build capacity in Africa's public service while maintaining its own integrity. But there are other big ideas keeping CEOs in Africa and indeed all over the world awake. There are 5 big front burner areas one can immediately see. The first area is proactively responding to the geopolitics, the dynamics in Syria, South Korea, France. A new Trump era portends a wave that will not leave markets unimpacted. Clearly, the biggest area to watch is geopolitics. Second is on coping with inflation, which may not abate as quickly as many expect. Third is leveraging technology and AI as alternative business models present vast opportunities and threats. Fourth is environment, social and governance, ESG, and navigating expectations in this area. Fifth is on managing talent as a changing workplace calls for fresh thinking. Let's hear what some of the experts are saying.
The feedback from CEOs in Africa was that their businesses have been affected by the changes in the geopolitical environment. It's created additional uncertainty in an already uncertain landscape. The main effects of it has been increased costs, disruption of supply chains, and an increased environment of uncertainty. What these have meant for African economies is imported inflation has been on the rise. As a result, CEOs are having to rethink their business models. They're having to do what we refer to as scenario-based planning, which is really planning for a wide range of outcomes that they previously had not had to take into consideration. We're also seeing that as a result of the geopolitical environment, it's important that companies are developing a risk management strategy focused on geopolitical risk. In other words, geopolitical risk management is now something that has come to the fore in many businesses. The response of businesses has been to look towards domesticating supply chains, look towards diversification of their products and services, an increased focus on cost optimization, and a general awareness that they've got to respond to changes in the geopolitical environment with speed and decisiveness.
The more we continue to look at the value chain of the business to see where we can strip out costs, what more we can replace locally, I think this will go a long way to help us. Improve your cash flow management, deploy your capital strictly where it will help you to get an improvement in growth. Not just where it's needed, but where it will deliver the most growth for you. Deploy your cash flow in that area. Offer your customers incentives to pay you early. Embrace technology. Technology can help you to reach more customers in a shorter time. So embrace technology to be more productive, to improve your productivity, and to strip some costs out of your operations. Improve your customer experience, definitely. What you're offering your customer, that experience needs to be improved significantly. Source more inputs that you can locally. Manage your treasury in an innovative manner so you have funds. Diversify how you manage the funds you have at hand. Negotiate for longer term contracts. In fact, similar businesses or businesses that use similar inputs can come together to negotiate bulk purchases that will bring down the cost for both of them. Who says you can't share containers? Who says you cannot negotiate to buy that input at a better price and split it when it arrives at your warehouse?
Technology is a force for good. It presents an opportunity to leapfrog several stages of development, but it comes at a huge cost. And many CEOs told us that they're finding that their spend on technology is becoming one of the biggest cost areas in the business. It's outstripping the spend on human resources. But that spend on technology, and in particular artificial intelligence, raises a number of ethical considerations. For instance, there's a recognition that artificial intelligence will make several jobs redundant. And the ethical issue that raises is whether that's the right solution for Africa, where we're seeking to raise the level of employment. Notwithstanding these ethical issues, the CEOs we spoke to recognize that AI is a force that cannot be stopped. And so the response of business has got to be to look at how to upskill employees to make them more future ready. It's a challenge for both business and governments across Africa. And a consequence of the rise in technology spend is also the increased risk of cybersecurity. This is, a key message and a key area of focus for all companies operating in Africa. You cannot take your eyes off cybersecurity risk, ESG. Now, for many, this is a buzzword, but for us in Africa, this is the reality of our existence. If you look at what we've experienced in Nigeria recently, in terms of all the flooding that has taken place, this is an environmental issue that has resulted in real social dislocation in terms of destruction of farmlands and increasing poverty. And the solution to this area lies, of course, in governance. When we spoke to CEOs across Africa, the response was mixed. For some CEOs, it was clear that the realization of the importance of ESG had not fully sunk in, while for others, there was a recognition that spending on ESG is one of the surest ways to achieve long-term value creation. Indeed, when we spoke to CEOs, they did tell us that providers of finance are increasingly asking companies to prove their ESG credentials. And the more successful they are in showcasing their ESG credentials, the easier it is to access finance and the lower the cost of that finance. The fourth area was in the area of talent. Now, this is a huge area. You know that we've experienced migration of talent in Africa, i.e. talent emigrating out of Africa. The consequence of that is that organizations have found that there's huge institutional knowledge that has left the organization as the employees themselves are leaving the organization. This has meant that businesses have had to really think seriously about how do we retain institutional knowledge in the business despite the loss of talent that has occurred. Again, in responding to this issue, we found that many CEOs are looking to technology. They're looking to technology to help to preserve institutional knowledge. You could almost say that they're spending on technology in order to people-proof their businesses. The other interesting thing we found in the talent area is that more than 80% of the CEOs we spoke to were adamant that over the next 3 years, there must be a full return to work. Now, you recognize that this is at variance with the expectations of employees. But when we drilled further into this issue, we found out that at the heart of it was the issue of productivity. CEOs are concerned about productivity. They're concerned about the passing on of organizational culture, and they're concerned about the weakening of the bonds between employees that comes when teams work in close proximity with each other. So again, we expect to see over the next couple of years an increasing number of companies that will be reducing the extent of hybrid work and asking for a full return to the workplace.
Asia Pacific markets were mixed as traders assessed revised economic growth data from Japan and China's November inflation data. South Korea's Kospi stock index fell the most as the fallout from the brief declaration of martial law continues to roil the country. Well, that's all we have on this episode of Global Business Insights. This is Bode Oshosami. Thanks for sharing on Facebook, LinkedIn, X, and YouTube. And again, thank you so very much for watching. Bye-bye.